Good morning, Energy Media readers, and today we are going to be talking about a very serious problem in the Alberta oil patch, and that is the plight of the junior producers. And to help me understand this, we've invited Richard Masson, who's an economist and an executive fellow with the School of Public Policy, University of Calgary. So welcome to the interview, Richard.
Great to be here, Markham.
Now, in December, the Alberta Securities Commission issued its latest oil and gas review, and it had some startling information in it. The number of juniors went from over 200 in 2016 to 89 in 2019, and the amount of money that they were able to raise in public markets fell to almost zero. And there is a capital crisis going on in the juniors. Can you give us some background on that, please?
Well, it's been a very tough period as oil and gas prices have been relatively low. It's been tough, but it's been particularly tough for juniors. So on the gas side, production of gas in the U.S. from fracking has grown tremendously. If you take the Marcellus in the Northeast, our key market from Alberta, gas has gone from about 2 billion cubic feet a day up to 16 billion plus cubic feet a day. So that 14 billion cubic feet a day increase is the same as the entire volume of gas Alberta produces right now. And that means that prices in North America for gas are very low, and junior producers who are aimed at gas production have had very low cash flow. So that's one of the things that's contributed to such a terrible environment for investment.
The other thing I think that, and this is particularly true around the market access, the pipeline issues, which have dominated the news in the last couple of years. And we don't talk about the effect of those on the juniors enough, because when the big companies like the Suncor and Cenovus's, CNRL in particular, they all protect their production from the differential. But it's the juniors who bear the brunt of that, because they're very often selling in Alberta at Hardisty instead of having their own pipeline capacity and getting full WCS. So they're getting it on the gas side, they're getting it on the oil side, and it's no wonder that we're seeing the kind of decrease in the numbers and the stress that we're seeing in that sector.
Absolutely. So if you go back to the fourth quarter of 2018, the differential between Western Canadian Select and WTI reached $50 a barrel. Normally it should be about 12. So that was huge. And not only that, light oil prices also saw huge differentials. Normally they're $4 or $5 a barrel, they were $30 a barrel. So cash flow was way down in all sectors of the industry. So the government came in with 325,000 barrels of curtailment, shut in production. And although that didn't affect the juniors directly, it really put a damper on the entire market. The investors looked at that and said, oh, this is new intervention by a government. We're not sure we're comfortable with this. It just added to another layer of uncertainty on top of the volatility of prices.
Now, Richard, you're involved with a favorite company of mine, Fractal Systems, which has a partial upgrading technology. And so you and the company have been out in the Alberta capital markets talking to investors, in fact, all of the investors by the sounds of it. What are they telling you?
Well, one of the things when juniors want to raise money is often there's high net worth individuals who have a great track record. They want to get involved in the next company. They may take a board seat for an investment. And those are the entrepreneurs that have helped finance development of junior companies in Alberta and Western Canada. One of the things we've heard is many of those folks have investments in companies, but there's no more liquidity in the market. There's no more exit strategy for them to sell their junior positions into medium or larger companies. And so that illiquidity means they're not interested in putting more money into the sector. So that source of capital has dried up for juniors who need money right now because they don't have the cash flow to keep going.
So this is a really serious problem, and I know that 3 or 4 months ago, a number of the gas producers, I think there were 9 of them, Chris Lubicki from Modern Resources was one of them. And they sent a letter to Premier Kenney, and they basically said, this is a crisis. If you don't do something in the next 12 to 18 months, we could see as many as 13 or 15 companies fail. I think maybe that was a conservative estimate. And the government, we know, is tap dancing, trying to come up with some kind of solution. But really, until the market access improves, we don't see any movement on gas much, long term anyway. Are we seeing the end of the junior sector in the Alberta oil patch?
It's a very difficult environment. So one of the things that was a challenge last year was, it gets a little complicated, but the ability to put gas into storage at ACO, near Medicine Hat, the big storage hub we have, is fundamental to junior producers. They got to be able to sell their gas and produce everything they can produce. And there was some maintenance issues on the inter-Alberta pipeline system that prevented that. So that got fixed. That was helpful. But the bigger picture is prices are going to stay low in Western Canada because they're staying low in North America. And yes, we are working to build an LNG project, assuming Coastal GasLink pipeline can overcome its difficulties. But that's not going to have a material impact on prices in North America. And so juniors face a long-term challenge trying to find ways to get their cash flow. And so it is very difficult right now. And the other thing I'd say is the Montney and the Duvernay, the fracking that we do here in Western Canada is relatively expensive. It's sophisticated, and not all the companies have the expertise or certainly the funds to do it.
Now, in 2016, 2017, maybe even 2018, we were seeing some of those failing companies, or the companies with damaged balance sheets that were being acquired by some of the bigger producers. But 2019 marked a bit of a departure, I understand, and now it's more bankruptcies.
It has been. So even the medium-sized and larger companies have been focused on paying down debt with the cash flow they have. And so some of the juniors weren't able to find a buyer, and there was a larger number going bankrupt than there were in mergers and acquisitions. I would say, some things are starting to turn around. So curtailment is easing. Crude by rail is ramping up. So that's been helpful, other than the slowdown from the rail derailment lately. But the environment could get a little bit better and start to see more M&A activity, which would help juniors say, well, maybe there is a light at the end of the tunnel.
But how bad is it going to be over the next 1, 2, and 3 years? I mean, even if some of the companies manage to hang on and strengthen their balance sheet, get more cash flow in their bank account, there must be some, I would imagine, who just simply aren't going to make it. They've been too damaged in the downturn.
Well, and this is the Darwinian part of the market. So the suppliers have had to manage their fleets, their pricing, to try and survive as well. And the suppliers take it on the chin quickly. Producers at least have revenue coming from their existing production, but suppliers have to earn the right to have a contract every single day. So pricing comes down, people work harder, it's the most productive employees who are retained. All of those things make the survivors stronger, and they're better positioned, when there is a bit of a turnaround. So there are going to be fewer companies involved. The ones who survive will likely be strong, and hopefully we'll see a bit of a light at the end of the tunnel, a change in some of these circumstances that allow growth to happen again. Certainly, Alberta needs that growth for rural communities. It's a very important part of their overall economic situation.
Last question, Richard. We know that Alberta, any oil patch really has booms and busts. That's the nature of the commodity market. And I've talked to analysts who say, well, here we go again. But is this unprecedented? The last few years where we've had this many juniors fail and had to have the sector in such tough shape?
It's, I've been around for 30 years plus, and it's certainly the worst I've seen it. It's been a long decline, and it's been a lack of funding for a long period of time. So, a lot of times people can bridge a 2-year gap, but it gets tougher after it's been this long. Lenders have been supportive in general so far because there's not a lot of market for them to take over assets and try and resell them. But, they still have issues to work out as lenders to figure out what's the best option. So there's a lot still to come here as the industry continues to consolidate. And it's hard to predict what's going to happen, but it's still tough circumstances. We need all the support we can get from governments to make this work the right way.
Richard, thank you very much for the interview today. And we know this is going to be an ongoing problem. We expect it to intensify in 2020, I would think. So I look forward to chatting with you again as we can update this story.
Appreciate the opportunity. Thanks, Markham.